Corporate Finance OneNote Practice Problem. Payback period computing projects of different lengths. Get ready, it's time to take your chance with Corporate Finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're going to be in the icon left-hand side. We're in the practice problems down in the 1217 payback period computing projects of different lengths tab. Also note, when using OneNote, look at the immersive reader. Our presentations will be mirrored down here in the text areas. Same name, same number, transcripts there, transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon out up top, we got our information up top. We're going to go through the calculation down below. We're going through the payback period again. That's going to be a type of calculation, one of many, that we can use to try to think about a situation where we're putting down an initial investment and we're going to get a return on that investment in the future. Payback period specifically looking at when are we going to get paid back, not taking into consideration the time value of money. Note that when we think about that question, then from a book standpoint, like a book question, if you're studying for this from like a book standpoint, they're going to try to emphasize the limitations of the payback period to show you that this is just one among many different types of things you might use when you're trying to peer into the future, trying to look into the future. Doesn't mean the payback period is bad or wrong. It means it's limited. It's only one kind of calculation that you're going to use, and not the one that you're going to rely on most. And the one you would rely on most typically would be some kind of method that uses time value of money, such as the net present value or internal rate of return, which we will talk about later. Now, so here you have a situation where the initial investment, and you can think about this initial investment as being in a project, in equipment, some kind of business decision where you're putting down money up front in order to generate revenue in the future. Then, in order to make a good decision, we want to think about, well, what are we going to receive? What are going to be the returns on that investment? The returns being longer out into the future makes it a more complex decision, increases risks most likely. So then if we go down below, we have our two items. We got the product X and product Y. We could think of these as two different projects, two different investments in equipment, similar kind of scenario. Then we're going to say the first one, X, has payments that we're going to be receiving 30, 20, 25, 50, and 40 from years 1 through 5, respectively. Product Y, the second option, is going to give a return on the 100,000 if we choose this one of 35,000, 30,000, and 35,000. So note that these two projects have different time lengths, and this is where there often are going to be limitations in the payback period. If we have the same amount of the investment, and notice if you're looking at two different projects, that could change as well, but we have different lengths of time that we're going to be receiving or generating our return on it, then the payback period is only going to tell us when we're going to get our initial investment back. It's not going to take into consideration basically the time value of money or even really what the net income of the project will be. So for example, if we added up the first project, we have 30,000, the 20,000, the 25,000, the 50,000, and the 40,000 we expect to receive in the 5 years, minus the 100,000 we're paying down today. If we do not take into consideration time value of money, we're getting 65,000 basically gross profit over that 5-year time period, not taking into consideration time value of money. Product Y, we have 35,000 plus 30,000 plus 35,000. We're only getting 100,000, and that's how much we're putting in. So with time value of money, we have to be losing money if you take into consideration time value of money. But if you look at the payback period, then you might not see that, right? You might be saying, when am I going to get my money back? And so let's compare these two with basically the payback period calculation here, and then consider that we would want to also be looking at some other calculations such as net present value, internal rate of return, time value of money calculations, which we'll talk about in future presentations. So let's take a look at product X. We're going to say that we have the initial investment. This is how you'd want to set up your table anytime you're looking at a payback period kind of problem. We're going to have the initial investment on the right. You might want to represent it as a negative number. It might help you to visualize it that way. But we're going to have because it might be an outflow to you that way. But we have the 100,000. Then we're going to say in the first year, we're going to get back 30,000. So 100,000 minus the 30,000. 100 minus the 30,000 means we've got, hold on a second, 100,000 minus the 30,000 means we have 70 left that we have not yet recovered. In year 2, according to our table, we're going to get 20,000. So minus the 20,000 leaves us with the 50,000 left. Year 3, we would put year 3, we're going to get back, we said 25,000 year 3, 50,000 minus the 25,000, it's going to give us 25,000. Year 4, we're going to get the 50,000 that we're going to receive. So 25,000 minus the 50,000 we get in year 4 means that we have returned now. So sometime between year 3 and year 4, we recover our investment. The payback period has happened. Note that this running balance is useful because that does get us to our net income number. If we continue this on down, we get to that 65 here, but that's not where our concentration is for the payback period. For the payback period, our imagination, we're saying it stops right there, right? That's what technically the payback period is. Now we want to see when we're going to get our money back somewhere between year 3 and year 4. So 3 point something, or 3 years and so many days, or 3 years and a fraction of so many months, right? So to do that, we'll do our fraction of a year calculation, which will be looking like this, the amount still needed at this point in time. So this between 3 and 4, that's when we stopped here. So we had 25,000 left after year 3 that we cleared in year 4. So 25,000 divided by what we're going to get in year 4, 50,000 is what we're looking for. So 25,000 over divided by the 50,000. Doing that calculation, 25,000 divided by the 50,000, that's going to give us 0.5. So you can represent that as a fraction. If they give you days in an answer key or something like that for a test question, you could take 360 days, for example, which would be 12 times 30 for even amount of days in a year. 365 closer to the fact, but we'll say 360 times 0.5, you're looking at 180 days in. Or you could take that 180 divided by 30 days in a month, gives you about 6 months, which of course you can also calculate taking 12 months times 0.5, 6 months. So that means we're talking 3 years, 6 months for payback to happen, meaning when we get our money back. You can also calculate that with a running balance down here, which might better visualize than doing this kind of calculation. It could seem a little abstract. So if you were to say day 1 to day 360, the way we did basically with the years, you could do the same thing. We're going to assume that we get this 50,000 evenly, over 360 days. So we would get then about $139 per day, and then we could just keep running that up and say, okay, we got 139 plus 139 gives us 278, and then year 3 plus 139, and so on and so forth until this ending number gets above what we need it to be, which was 25,000, above this 25. So when does it go above 25? Looking 25,000, can we get us a 25,000? There it is right there at 0.5, right? The 0.5 or 180 days in, that's when we clear the 25, and everything after that is at profit at that point in time, which is 180 days over 360 days. What happened? I don't know. 180 over 360 gives us our 0.5. So that's half the year, right? Half that year. So that means that we got our 0.5. That's the 3.5. Let's do the second project this time. Let's do that one, and then we can compare one and the other. So now we're on product Y, which has a return of only 3 years here. 3 years. So let's check that one out. So we're going to say the initial investment, 100,000 again. We're going to get 35 back after year 1. So we'll say 100,000 minus 35,000 gives us 65,000. And then in year 2, we're going to get back 30,000. So minus the 30,000 means we're left with 35,000 we haven't got back yet. And in year 3, we get back the 35,000, which brings us to 0, which means it took us 3 years exactly to get our money back. We don't have to do any fraction of a year here because it was even. So 3 years exactly. So then the typical question you're going to have is going to be, well, the book question is going to be, you're going to have to explain this. Which one would you choose under the payback period? Well, you would obviously choose the second one here, because you're going to get your money back in 3 years, as opposed to the first one where it's going to take you 3.5 years. And I want my money back sooner. And then the next question would be, well, does that make any sense? And the answer is no. Of course that doesn't make any sense, because we just determined the fact that the second one doesn't give you any actual profit. Why would you put 100,000 down to get that back 100,000 3 years later? Because that doesn't make any sense. You're just taking on risk and you're not actually generating any revenue. So that obviously doesn't make any sense. But if we just use the payback period, then that's the one we would choose. That's why the payback period, and that's what a book question will ask you. And they'll say, hey, this is the limitation of the payback period. And you're going to walk away saying, well, why are you even showing me the payback period if it has that severe limitation? And it doesn't mean the payback period is bad. Again, you might use the payback period because it's useful to know when you get your money back. And that's a good calculation to have. But it doesn't tell you what your total profit will be, even though when you do the calculation, you'll be able to see that. And it doesn't give you the time value of money. And it's particularly bad if you're comparing two different projects that have, say, different investments and different time horizons as in terms of when you're going to get paid back. So for book problems, expect that. Don't be down on the payback period just because it has those limitations. Just know the limitations in practice and be aware of them. When you're doing book problems, realize that the book problem is probably going to emphasize the limitations of the payback period, so you're aware of them and leads you into what is the preferred method of calculation for long-term projects, which is taking into consideration the time value of money. That's the net present value calculations and the internal rate of returns calculations, which we'll talk about in future presentations.